Let's get started today. First one says, when reconciling variable costing and social costing, net operating income, fixed manufacturing overhead costs released from inventory and absorption costing, to reduce from variable costing to arrive at the absorption costing net operating income. And remember, that answer is going to be true. Because remember, we have to reconcile. So part of the reconciliation process is to follow that process. And now, number 2 says, since variable costs emphasize cost by behavior, it works well with the cost volume profit analysis. That's also going to be true. Again, variable costing, like it says here, focuses more about what's going on with the production, which is obviously relates to cost and volumes because they're all tied together. Your volumes dictate your costs, which also tie into your profits. Number 3 now. It says here, your production exceeds sales for the period, variable cost and net operating income would typically grade the absorption cost and operating income. That one is actually going to be false. Again, because that happens doesn't mean it's higher. Now it says, assuming that direct labor is a variable cost, product cost and the variable cost include. And here, we know it's include our main costs, direct materials, direct labor. Okay, another one is, what they all tie together is you're always calculating direct materials, direct labor. The last one's going to be your manufacturing overhead. Remember, that's a variable because overhead can depend. If you had a busy period, maybe not too busy this period, what's going on with the period? That fluctuates each period. Now, number 5 says the costing method that can be used most easily with a break-even analysis and other cost volume profit techniques is. We have several ones here we've done over time: variable costing, absorption costing, process costing, job order costing. Except this one refers to mainly variable costing. Again, variable costing is focused on the CVP techniques, which is cost volume profits. And we see as costs fluctuate, and they tie into volumes and of course profits. Okay. And the next one, which of the following costs at a sofa manufacturing company would be treated as a period cost under the variable costing period? Okay. Again, here we have the cost of glue used to assemble, depreciation on sales vehicles, salary of factory manager, or both B and C. Okay. The answer is going to be D, B and C. Remember, period cost as it relates to that period. Cost of glue, kind of, but in the meantime, cost of glue is more as indirect labor. Indirect materials. That's going to be indirect materials we're going to use. And period costs, depreciation, and of course, a salary. Now, number 7 here says, Megan Corporation produces a single product and has the following cost structure. Okay. It says here, number of units produced each year, the unit product cost under absorption costing. Well, the first thing you got to calculate before we go any further is we want the unit fixed manufacturing overhead. Okay, remember, to get this, take your fixed manufacturing overhead, which is 91,000, and divide by the units, which is 7,000. Okay, so when we do this, that'll be $13. Okay, and then the next part is, we calculate the unit product cost. Now, to get the unit product cost, the first thing is you want to add, which is all given to us, add your direct materials, which is $81. Okay, next thing you want to do is add your direct labor, which is $40. You also want to add your variable manufacturing overhead, which is $5. And the last thing you want to add is your unit fixed manufacturing overhead, which we just calculated is $13. Okay, so add all that up, that'll be $139, which is answer C. Okay, the next one now, number 8. It says Cadwell Company, which has only one product, has produced the following data concerning its most recent operations. We have selling price, you begin inventory, produce, or variable costs, fixed costs. As it says, the company produces the same number of units every month. Although sales in units vary from month to month, the company's variable cost per unit and fixed costs have been constant from month to month. what is the net operating income under variable costing? Now remember, to get the net operating income, we're still going to start with sales revenue. It says here the selling price is $127. Take the $127 and multiply by how many units sold. So go back up here. You see we sold 5,400 units. Okay, when we multiply those out, we see here the sales revenue is $685,800. Remember, we're doing variable costed, so now of course the next one to get is less your variable costs. So the first variable cost we have is product cost. Okay, so to get product cost, again, we go right back up here. See, what is the product cost? Okay, so this one actually we're going to have to calculate. And remember, the product cost, again, still going to be by units sold, so multiply by 5,400. Okay, so again here, take our direct materials. Here, our direct materials is $38. Okay, plus the direct labor, which is also $38. Plus the $1 variable manufacturing overhead. Okay, so when we do this, that'll be 5,400 times $77. Okay, when we do that, that'll be 415,800. And then the next part you want to take out, also want to take the variable selling and administrative expense. Okay, that one is just a flat amount. It's $11. Again, multiplied by the 5,400 units sold. So we have here, that'll be 59,400. So again here, so we did that. So we see what is our total variable expenses. Okay, we take the 415,800 plus the 59,400. That'll be 475,200. Okay, so again, now we take our sales revenue minus our total variable expenses. This will give you your contribution margin. Okay, subtract those. That'll be 210,600. Now we did to get our variable expenses. Now it's time to take out our less our fixed costs. The first one we have is our fixed manufacturing overhead, okay, which is 153,700, and also our fixed selling and administrative expense. So we see that's going to be 48,600. And again, so we do the variable expenses, you want to add them up. Okay, so when you add them up, that'll be 202,300. Okay, the last part, now we're ready to calculate your net operating income. And the last part says here, take your contribution margin minus your total fixed expenses. Take the 210,600 minus 202,300. Which is $8,300. On the next one. Okay, so this one says here, a little different. It says here, Arbus Corporation manufactures a variety of products. Variable cost and operating income was $62,800 last year, and it was $74,900 this year. Last year, in inventory decreased by 3,300 units. This year, an inventory increased by 1,900 units. Fixed manufacturing overhead cost is $7 per unit. What was absorption, costing, and operating income this year? Okay, so again, what we're looking for is the absorption, costing, net income. Okay, remember to get the absorption cost of net income, what you want to do is, let's take a look here. Take your variable cost of net operating income, which we know is 74,900. And what you want to do is add the fixed manufacturing overhead deferred. Okay. See in here, it says here it's $7 per unit. So take $7 per unit and then multiply by the $1,900 increase. Okay, so when we do that, that'll give us $88,200, which is answer A. All right. It says here, last year, Bronco Corporation variable cost of net operating income was $93,500, and inventory increased by $800, or 800 units. Fixed management overhead cost was $7 per unit. To determine the absorption cost of net operating income. Okay, well, first of all, we have our information here. So the first part is we have is the variable costing net operating income, which is $93,500. And then what you want to do is add the fixed manufacturing overhead costs deferred in inventory under absorption costing. Which we see there, this we have to calculate. This we do not have. So again, let's go back to what we have now. Remember, to calculate this, start with your change in units in ending inventory. Okay. It says here 800 units. We got 800 here. And the next thing we're going to see is what is your fixed manufacturing overhead cost per unit. And remember, that's $7. So again, we're going to multiply those together. This will give you your change in fixed manufacturing overhead in ending inventory. Again, when you multiply it together, the 800 times 7, that'll be 5,600. So go back up here, add the change right here, which is 5,600. Okay, so again, when we add all this up, this will give you your absorption costing net operating income. So when we do that, that'll be $99,100. Okay, class. All right, class. Hope everyone's doing well. Let me know if anyone has any questions. Okay, thank you.